Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 5th of November. I'm Daniel Lam, your host for the podcast. The election of Trump back in November 2016 arguably halted the trend of globalization and moved the world into a state of protectionism. Now, 8 years on, the biggest asset class out there, i.e. FX, is reflecting a potential return of power from Donald Trump, and we can learn from its implications. Now, the US dollar and volatility have rallied in lockstep with the increase in Trump's prospects in the polls and betting markets. The US dollar rally since the end of September has been fairly broad-based across EM and G7 currencies. The declines against the US dollar have been led by the yen, Korean won, and Australian dollar, and this reflects a mixture of high and low yielders, but all have been typically high beta FX moves. Now, the move in FX volatility have also been fairly evenly distributed, although in the last 2 weeks, there has been a surge in volatility for pairs seen as most exposed to US political outcomes, such as US dollar CNH and US dollar Korean won. Now, since the middle of July, the EM/FX Vol Index has increased by nearly 50%, and the G7 Index has rallied by around 30%. So the increase in FX volatility measures largely reflects concerns around Trump's tariff proposals. However, if fiscal policy also turns out to be more expansionary, this can force a repricing of FOMC rate cut expectations, push US rates and the dollar higher. Now, the economic impact of across-the-board tariff would hit the more open and trade-dependent economies in Asia the hardest, affecting Korean won, Malaysian ringgit, and Singapore dollar. Now, there is downside risk to global growth from Trump's tariffs, even if we do assume that the proposals that we're speaking about would be only starting points for negotiation. Now, another currency that is worth highlighting is the euro. So that remains vulnerable to an increase in global trade tensions. Now, the growth in euro area is already struggling to build positive momentum due to a slowdown in the manufacturing sector. And Trump may look to target the EU more directly if he were to be elected. Now, euro area countries may also be forced to increase military spending further if Trump follows through on previous discussions about reducing the US commitment to NATO. Now, the point is that the Trump election victory may lead to a reallocation of spending in the euro area from domestic investment towards military spending. And of course, Trump's economic proposals may result in a period of sharper monetary policy divergence between the Fed and the ECB. Now, finally, gold, we've been highlighting that as a beneficiary regardless of who wins. That is riding strongly on official sector demand. Now, we believe that gold may be anticipating renewed pressure on the Fed's independence if Trump were to be re-elected, or perhaps there would be delays in finalizing the election result. The march higher in gold prices may also reflect a concern that currencies could increasingly be used as bargaining chips in geopolitical discussions. So this can encourage both public and private sector investors to diversify further into gold. That is all from me for today. As always, if you enjoy these podcasts, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.